Hello, everyone. I'm Chad Frantzen. Welcome to the Kingdom Finance Show. On today's program, I'm going to talk about our thoughts, my opinions on the U.S. stock market and the U.S. economy for September 2024. With that, let's jump in to today's program. We're recording this the second week in September, the week of September 11th, where we remember the lives lost at the World Trade Center 23 years ago today, this past week. And a lot going on in the world today. And my goal for today's show is I'm going to take a bit of a deep dive into the U.S. market, the economy. We're going to talk a little bit about the Federal Reserve. So that's the goal for today's show. So I'm going to cover some technical data, but really I'm going to share with you my opinions. Again, this program not designed to give you financial advice, really just to give you education and hopefully clarity out of chaos with what's going on in the markets, the capital markets in the U.S. and worldwide. Well, let's go ahead and talk about what's been happening, particularly in the month of August and heading into September. Of course, we are in 2024, which is a presidential election year in the United States. So a lot of volatility picking up with a lot of contested elections, not only at the White House level, but in the Senate and even across individual states. So a lot going on September and October. Historically, if you're just a student of history and the markets, September and October have always generally been, if you go back and look at the history books, very volatile months in the capital markets. Even the 2008 crash, that really kicked off primarily in September of October. We had the big, Black Friday crash, Black Monday, right? Black Monday of 1987 on that. So not a given. We have seen volatility start to pick up. But what I want to start with on today's episode of the Kingdom Finance Show, I want to talk a little bit about what's happening in the economy. We have the great American job creation machine, right? It has been slowly slowly slowing down, if that makes sense, over the summer of 2024. Now, the economy, particularly jobs market, has been actually surprising to me, very resilient over the last year. But what we're seeing is we had the August jobs report for 2024 came out about a week ago as of the recording of this show. Again, we're recording this mid-September 2024. And what that jobs report showed is that job creation is slowing down, even though unemployment rate is remaining relatively low. In fact, the data was somewhat ambiguous. The big question in Vegas, if you will, is the Federal Reserve, which is led by Chairman Jerome Powell. They are the main regulatory body in the free world of monetary policy, and they run the U.S. Federal Reserve System. Again, monetary policy, I'll talk a little bit more about that here in a minute, why it's important, whether you are a stay-at-home mom, a retiree, or an entrepreneur, how that matters to you. But interest rates are going down. We're already seeing the U.S. Treasury market. If we look at the bond market, it's already come down quite a bit. I'll mention some of those stats here shortly. But the data still leaves some people on the fence as to whether or not the Federal Reserve at their next meeting, which is going to be September 18th. It's about a week from this recording. You may be watching this and the Fed will have already met. But a lot of people, almost everyone believes the Federal Reserve will cut the Federal Reserve rate by 25 basis points, which means 1/4 of 1%, so 0.25%. There's still growing sentiment among prognosticators, economists, people much smarter than me, that believe that the Fed will cut 50 basis points or 0.5 So 0.5%. But the jobs report didn't give a clear answer if that would be the case on that. The bottom line is that about 5 or 6 weeks ago, the July jobs report was surprisingly weak, and it set off all types of alarms. We even saw a lot of volatility. If you were watching the stock market, the bond market, the crypto market in the first part of August, there was all sorts of panic, volatility, people running for the exits, if you will, in the capital markets. It was really based on that July jobs report, which made a lot of people get spooked about, oh, maybe we are heading into a recession. Maybe the economy is really much slower than what we had been anticipated. Now, the August jobs report, and what it has confirmed is that the slowdown is real. It is underway. It's not a super weak number that makes that data point alone say, hey, we're already in a recession. My personal opinion, I do feel a lot of parts of the economy are already in a recession. If you go talk to small business owners and how they're being affected by current policies in their small business, they're very much in recession. A lot of small businesses are closing. I was just reading a stat this week about the number of bankruptcies. That's at a very high number. So again, I guess that's relative. With food prices as high as they are, and inflation and purchasing power being what it is, a lot of parts of the economy are in a recession. Well, what a lot of experts are saying is that, a lifeline from the Federal Reserve in the form of an interest rate cut is really imminent. We've been at very high rates for a very long time now, but there's questions, and this is a key point. What the market is really wrestling with is, are the interest rate cuts coming too late, or will it be strong enough to pull the market back? That's kind of the key thought. So don't be surprised to see, my opinion, to see increased volatility in the capital markets. That's in the stock market, especially crypto market for sure. The bond market, we're already seeing a lot of movement there. Employers continue to add jobs, but the current pace is definitely, we're definitely coming into a school zone, if you will. It's not as fast as a lot of people had wanted. Now, that all comes from the Bureau of Labor statistics that come out every month. So what's the big picture? The jobs report was the most highly anticipated report in quite a while because of what it will suggest about Federal Reserve policy on interest rates. The report doesn't necessarily settle the question. On the one hand, unemployment didn't continue to rise as it did in July. Wages were fairly solid, and job growth remains on the positive side of the ledger. But again, with all these type of government reports, there are what we call revisions. And so we even had some reports come out here recently where there was a revision downward of how many jobs were created in the U.S. economy over the last 12 months, going back to 2023 into the first part of 2024. So some of these revision reports have come out and said, well, the job market of the U.S. economy actually wasn't as strong as we had been reporting. There was close to 1 million jobs that weren't actually created on that. So that does make the case for those who believe a larger interest rate cut is coming in September. Now, I mentioned the bond market earlier. Bond market is a very good leading indicator, a predictive indicator, in my opinion, on the health of the economy. 2-year U.S. Treasuries have been somewhere around 3.7%. Now, these rates change from day to day, so they may be a little different when you hear this podcast. With the Fed's short-term policy, now remember the Fed's rate is 5.5%. So what that tells you is the 2-year U.S. Treasury is around 3.7%. The Federal Reserve rate is 5.5%. We don't have to have fifth grade math will tell us enough to know that 5.5 significantly higher than 3.7. So what that means, the bond market is pricing in meaningful rate cuts, right? 5.5 is where the Fed's at. The 2-year U.S. Treasury is at around 3.7. So there's a lot of room the bond market is predicting for those rates to come down. I'll share this here in a little bit. We've got 3 more Federal Reserve meetings with Chairman Powell in the U.S. Between the recording of this show and the end of 2024. Now, there's not a lot of more major data coming out. We do have some CPI and PPI, which are inflation indexes that'll be coming out. But for the most part, I think the Fed's really dialed into what they're going to do. The Federal Reserve meeting September 17th and 18th of 2024. So again, bear that in mind when you're listening to this show on that. The Fed also has 2 more meetings after the September meeting. Interestingly enough, the Fed meeting in November 5th and 6th. If you're keeping score at home, you know November 5th is the day of the presidential election. And so we expect a lot of fireworks November 5th, 6th, and 7th with a highly contested election and with the Fed announcing what could be another rate cut the same week, same day as the presidential election. And then finally, the Fed's last meeting for 2024 will be December 17th and 18th. So let's try to handicap this a little bit. We've got 3 more Fed meetings. The Federal Reserve rate is at 5.5. The U.S. bond market, just based on the 2-year U.S. Treasury, is at 3.7. It is, let's say 90%, nothing's 100% in life, but it is extremely likely that the Fed will at least cut interest rates by 25 basis points at the September Federal Reserve meeting. Now, there's a slight chance that the Fed may proactively decide to cut rates 50 basis points or 0.5%. I don't personally feel that way. I think I'm more in the camp that a 0.25% rate cut is a given for the September meeting. I do personally expect that the Federal Reserve will also cut rates 25 basis points at each of the next 2 meetings, November and December, and that will get that Federal Reserve rate that's at 5.5 down to around 5 to 4.75% by the end of 2024. Now, certainly, I wouldn't put it past the Federal Reserve if the markets have a huge pullback. The Federal Reserve, in the past, historically speaking, has been reactive to what the capital markets are doing. So it wouldn't surprise me if we see a huge stock market downturn in October, that in November the Fed might lower rates 50 basis points. But again, the good news, lower rates are coming. They're already predicted in the bond market. So you're seeing that in CD rates at banks. You're seeing that in mortgage rates if you're buying a personal residence or investment property. Again, so you don't have to wait for the Fed to cut the rates. Markets are very dynamic when you're in a capitalist society. So those rates have already really been baked into a lot of what you're seeing in bank CDs, loan rates, and so forth. All right. Well, let me share a little bit on a couple different thoughts from some of the analysts, quote, experts. Let me summarize this, and then what I want to do for the rest of the show, and thanks for being here. Please like and subscribe to the Kingdom Finance Show. Really appreciate you following us, and I hope this is helpful. Again, some weeks we talk more on the economy and markets, and other weeks we talk more about different topics. What I want to do for the remainder of the time is I'm going to give you some thoughts on the stock market. Again, just my opinion, not giving you advice. If you want financial advice, I can tell you how to get that. That's not what this show is about. We do have Wealth Builders Investments. You can visit us online at wealthbuilders.net/invest. We've got a team of advisors. We would be happy to visit with you and your family, your company, your ministry on how you can put together a financial plan that has clarity and purpose with what you're doing. All right, well, let me dig back in here. Let's take another deep dive. again, we talked about Jackson Hole and the meeting that the Fed had in August on the last show, but let me just give you a little reminder on this federal funds rate. The federal funds rate is the interest rate that banks in the United States pay each other to borrow or loan money in what's called overnight loans. The Federal Open Market Committee, FOMC, so if you run across that in social media or the newspaper, that's led by Chairman Jerome Powell. They are the ones that set the rate. So the Fed meets 8 times in 2024, and they decide whether to keep rates the same, whether to increase them, or whether to reduce them. Think of this process as a lever that the Fed can push to tighten or pull down to stimulate the economy. So if you're a small business owner, then if rates are higher, it's more restrictive. There's less access to capital to expand your business, to start a new business, and so forth, because money is expensive. When the Fed pulls down the rate, it stimulates the economy. Money can move through the system with a little bit more velocity, if you will. And so for a business that's wanting to expand and hire and grow, for individuals who are wanting to buy real estate investment property, for someone who wants to start a company, capital, the cost of capital is a little bit more affordable. Now, the federal funds rate is an important benchmark that really has a ripple effect through all the other parts of the market, whether it's mortgage rates, U.S. Treasuries, corporate rates, and really credit is the most important part of the U.S. economy, but it's probably the least understood. It's the most important, again, we're talking about credit, because it's the biggest part of the economy, and it is maybe even the most volatile. Now, remember in early 2022, the Fed funds rate was almost zero, right? And the Fed was pouring billions of dollars into buying bonds every month. They were buying bonds every month to keep the economy propped up. Not only was that free money really being printed out of thin air, but it also enabled you and I to take advantage of really low borrowing rates. Think about how much adrenaline that provides to the overall economic system. The Fed kept its foot on the gas pedal even as U.S. inflation hit levels not seen in 40 years. Remember, we have charts where we look at inflation and it's 8 to even 9%. So, but when the Fed finally decided to tackle inflation, it did not hold back. In the past 2.5 years, now we're recording this in September of 2024, the central bank has tightened money supply through the federal funds rate by over 5 percentage points. Remember, I said earlier it was 5.5 right now. This aggressive move has started to cool off inflation, runaway inflation, and we've seen that in some of the factors. We do know parts of the economy of what you and I spend are extremely higher. You look at auto insurance, you look at rents, you look at food. There's a lot of things that are 20, 30, 40% higher than what they were before COVID, which is just crazy. A lot of the key economists think that a equilibrium rate for the federal funds rate is somewhere around 3.25 to 3.5%, right? So that's about 2 percentage points below where we are. Not to get overly detailed on this, but I just want you to understand how this is working. So that's really one way to view how this is going to work going into 2025. We're at 5.5 now. I think we could realistically be around 4.75, 5% by end of the year. But really, equilibrium would be great, probably around 3.25 to 3.5%, depending on how you view that. Well, good. Well, hey, that's a lot on the economy, even for me. A lot of data coming out. I hope that's helpful. Again, money supply is really important, whether you're a retiree, a small business owner, whether you're running a small company or a large company. I want to finish today's show just with a couple of minutes. Appreciate you being here. Again, if you want to connect with us for personal financial advice, go to wealthbuilders.net/invest. I want to share just a couple of thoughts from some of the portfolio managers that we follow. And on what's going on with the markets. We talked about The weakness in July and what happened in the 1st of August, 2024, we saw a sharp sell-off across all markets, stocks, bonds, crypto, but then they rebounded quite nicely and we're back near to all-time highs. Investors seem quick to cheer the fact that inflation is cooling off, yet equally worried that the economy is slowing down too fast and that a recession is either already here or right around the corner. August did bring about an unsettling jobs report, right? Showing that jobs, as I mentioned earlier, slowed more than expected, and the unemployment rate's around 4.3%. That's the highest since October 2021. Again, in summary, the rate cut seems fairly cemented for the September meeting of at least 25 basis points. And, there's an outside chance that they'll reduce it by 0.5% or 50 basis points. Despite all this anxiety and the slowing labor market, there's still some bright spots in the economy. Inflation at its core remains in check, and corporate profits are hitting new record highs. The previous leadership in growth stocks has been hit really hard as money has been rotating towards more defensive sectors, or what we would call value stocks. Despite the shifts within the sectors, we're seeing no directional changes in the market. A lot of portfolio managers are reducing exposure to some of the more volatile parts of the stock market, that being tech and high growth, and being a little more tactical in nature on that. Well, I hope that's helpful for today's program. Again, today I wanted to focus on the economy, give you some thoughts on the market. Again, these are just summary of reports I read from analysts and portfolio managers, kind of putting together my personal opinion on this. And again, the most important thing is just to stay informed and really creating your own financial plan. Everyone's different and unique in where they are and what they're stewarding as far as businesses and families and resources. But again, this is important, so thank you for being a part of the Kingdom Finance Show today. Again, please like and subscribe to the program, and we'll see you next time on the Kingdom Finance Show. Thanks so much.
Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. Content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine risk factors and other information contained in the memorandum.